Right now, retail investors are standing in line, waiting for the historic OpenAI public listing. They see ChatGPT everywhere, and they assume OpenAI is the undisputed king of the upcoming trillion-dollar AI IPO boom. But behind closed doors on Wall Street, the narrative is completely different. While the public focuses on ChatGPT, institutional venture capital, private equity giants, and the world's most sophisticated hedge funds are quietly shifting their capital. Just days ago, both companies filed confidential IPO documents with the SEC. But the smart money isn't chasing the household name anymore. They are dumping OpenAI for Anthropic, and a massive valuation flip just occurred that proves it. In this video, we are breaking down the internal financial disclosures, the hidden unit economics, and the critical structural shift that Wall Street is capitalizing on, and how you can position your portfolio before these stocks hit the public markets this fall. To understand what the smart money sees, we have to look at the raw data from the massive funding rounds that just closed. In March, OpenAI closed a massive funding round, bringing its post-money valuation to $852 billion. For weeks, the media called it the most valuable startup on Earth. But that title lasted less than 2 months. At the end of May, Anthropic shocked Silicon Valley by raising a staggering $65 billion in a Series H round led by Altimeter Capital, Dragoner, and Sequoia. That single round propelled Anthropic's valuation to $965 billion. For the first time in history, Claude has officially leapfrogged ChatGPT in valuation. But a valuation is just a number. What's truly terrifying to OpenAI's backers is the trajectory of the revenue run rate. At the end of 2025, OpenAI was dominant, generating a massive lead. Today, OpenAI is generating roughly $2 billion a month, putting them at a $24 billion annualized run rate. That is unprecedented growth for a software platform. But look at Anthropic. Anthropic started 2025 at a mere $1 billion run rate. By December, they hit $9 billion. And according to their internal May 2026 financial disclosures, Anthropic's annualized run rate has exploded past $47 billion. Let that sink in. Anthropic didn't just catch up to OpenAI. From a standing start, they are now generating nearly double the annualized revenue of OpenAI. And the institutional money is following the growth. So, how did a company that was considered a smaller, secondary player 12 months ago completely outrun the creator of ChatGPT? It comes down to a fundamental rule of elite investing. Consumer hype is fickle, but enterprise revenue is sticky. OpenAI built its empire on the consumer. Hundreds of millions of people use ChatGPT. But consumer subscriptions are inherently unstable. Users churn. They sign up for a month to try a feature, and then they cancel. To sustain its $24 billion run rate, OpenAI has to spend astronomical amounts on consumer marketing and global user acquisition. Anthropic, from day one, ignored the consumer mass market. They focused purely on the developer and the enterprise workflow. And in mid-2025, they dropped their secret weapon, Claude Code. Instead of building a chatbot for people to write essays or generate poems, Anthropic built an AI agent that integrates directly into the software architecture of major corporations. Today, Claude Code writes over 80% of Anthropic's own internal infrastructure code, and major enterprise clients are deploying it at massive scale. When a Fortune 500 company integrates Claude into its software stack, they don't buy a $20 monthly subscription. They sign multi-million-dollar annual licensing agreements that are locked into their operational budgets. This enterprise dominance has given Anthropic a massive advantage in revenue density. And it gets worse for OpenAI when you look at what it actually costs to make $1 of revenue. In the venture capital world, revenue means nothing if your cost of goods sold eats your entire margin. And this is the exact metric that is causing institutional investors to quietly exit their OpenAI positions via secondary markets. OpenAI is currently burning cash at an apocalyptic rate. Internal projections leaked during their recent legal battles reveal that OpenAI is on track to lose over $14 billion this year alone, driven by an estimated $17 billion compute spend. They have committed over $1 trillion to infrastructure partnerships over the next decade, and their own CFO, Sarah Fryer, noted that the company does not project positive free cash flow until 2029 or 2030. OpenAI is making a massive winner-take-all gamble. They believe that if they spend enough capital, they will achieve absolute model supremacy, and that supremacy will eventually justify the cost. Anthropic is taking the opposite approach. Because their models are highly specialized for enterprise data and coding rather than broad, omnimodal consumer capabilities, their training costs are drastically lower. Data models show that Anthropic is spending roughly 4 times less than OpenAI to train and maintain their core systems. While OpenAI is projecting an $85 billion annual loss by 2028 to keep up with infrastructure costs, Anthropic's current trajectory puts them on track for full operating profitability by late 2027 or early 2028. For hedge funds looking at an impending IPO, the choice is clear. Do you buy a company losing billions with a consumer audience that could leave at any moment? Or do you buy the company that controls the enterprise infrastructure, generates double the revenue, and is months away from turning a net profit? There is one final factor driving the smart money toward Anthropic, and it's something retail investors completely overlook: governance and regulatory risk. OpenAI's corporate structure has been a headache for institutional investors for years. The constant friction between its nonprofit board and its for-profit arm creates systemic risk. Wall Street hates uncertainty, and the threat of abrupt leadership changes or regulatory interventions hangs over OpenAI like a shadow. Furthermore, the major stock indices are watching closely. Just recently, the S&P Dow Jones indices declined to fast-track these ultra-highly valued AI firms into the S&P 500 immediately post-listing, citing concerns over long-term structural stability and public float restrictions. Anthropic, founded by former OpenAI researchers who left specifically over safety and governance concerns, was built from the ground up to be corporate-friendly. Their strict adherence to safety frameworks and constitutional AI isn't just PR. It's a legal and compliance shield that enterprise legal teams demand. Hedge funds aren't just buying Anthropic for the technology. They are buying the lack of corporate drama. It is a stable, highly predictable enterprise software machine. So what's the play for us? As retail and accredited investors preparing for the massive public listings this autumn, the lesson from the smart money is clear. Look past the consumer hype. Don't judge the future of artificial intelligence by the App Store download charts on your phone. Look at the data centers. Look at the corporate enterprise integrations. Look at the unit economics. OpenAI may have the cultural spotlight, but Anthropic is quietly winning the battle for cash flow density. Both companies are slated to go public by October of this year, alongside Elon Musk's SpaceX on June 12th, creating a multi-trillion-dollar shift in capital. We are tracking the S-1 filings weekly to map out our exact pre-IPO capital allocation strategy. If you want to build and protect serious wealth during this generational tech transition, make sure to hit that subscribe button, turn on notifications, and drop a comment below. Are you betting your capital on OpenAI, or are you following the smart money into Anthropic? This is Big Wealth Insights. Thank you for watching, and click on the next video. We'll see you in the next video.